Question 1. Scenario-based. Mr. Johnson, the 67-year-old Connecticut resident, is reviewing a long-term care insurance policy that includes home health care and assisted living facility coverage. He is concerned about inflation eroding the value of his benefits over time. Which of the following options would best protect Mr. Johnson's future purchasing power without dramatically increasing his premium? A. A policy with no inflation protection. B. A policy with simple inflation protection at 3% per year. C. A policy with compound inflation protection at 5% per year. D. A policy that allows for a one-time inflation adjustment after 10 years. Answer. C. A policy with compound inflation protection at 5% per year. Explanation. Inflation protection is a critical feature in long-term care insurance because it ensures that the policy's benefits keep up with the rising cost of care over time. Simple inflation protection increases the benefit by a fixed amount each year, while compound inflation protection increases the benefit at a compounded rate, providing significantly more protection over the long term. Given that Mr. Johnson is concerned about the erosion of benefits over time, a compound inflation protection at 5% per year will better safeguard his purchasing power in future years as care costs rise. This aligns with Connecticut's requirement for inflation protection in partnership policies, especially for older individuals who may need benefits 20 or more years from now. Question 2. Which of the following is not a valid benefit trigger for a long-term care insurance policy in Connecticut? A. Inability to perform 2 or more activities of daily living adults. B. Cognitive impairment certified by a physician. C. Diagnosed with a terminal illness, regardless of care needs. D. Requirement for substantial supervision due to severe memory loss. Answer. C. Diagnosed with a terminal illness, regardless of care needs. Explanation. Long-term care insurance policies typically use 2 main benefit triggers. 1. The inability to perform a specified number of activities of daily living adults, such as bathing, dressing, eating, etc. And 2. Cognitive impairment that requires substantial supervision. A diagnosis of a terminal illness without a need for assistance with a DLS or supervision due to cognitive impairment does not automatically qualify someone for long-term care benefits. Connecticut's rules align with federal guidelines that require policies to clearly define these triggers. Options A, B, and D are valid triggers as they directly involve an inability to perform necessary functions of daily life or the need for supervision, both of which are core to long-term care policy eligibility. Question 3. In Connecticut, how are premium increases on long-term care insurance policies regulated to protect consumers? A. Insurers can increase premiums annually without any restrictions. B. Premium increases must be approved by the Connecticut Department of Insurance, DOI, and justified based on claims experience. C. Premium increases are capped at a maximum of 2% per year. D. Insurers are prohibited from raising premiums after the policy is issued. Answer. B. Premium increases must be approved by the Connecticut Department of Insurance, DOI, and justified based on claims experience. Explanation. In Connecticut, insurers cannot arbitrarily increase premiums on long-term care insurance policies. Any rate increase must be approved by the Connecticut Department of Insurance, DOI, and the insurer must demonstrate that the increase is justified, typically due to higher than expected claims costs. The DOI reviews factors such as actuarial data and the insurer's financial stability before granting approval. Option A is incorrect because insurers cannot increase premiums annually without oversight. Option C is incorrect as there is no fixed cap, and option D is incorrect because premium increases can occur, but only with DOI approval. This regulatory oversight is crucial to preventing unfair premium hikes and ensuring policyholder protections. Question 4. Under Connecticut's Partnership for Long-Term Care program, what is the main benefit of purchasing a partnership-qualified long-term care insurance policy? A. Guaranteed policy renewal regardless of health status. B. Full Medicaid coverage after long-term care benefits are exhausted. C. Asset protection from Medicaid spend-down requirements. D. Low premiums compared to non-partnership policies. Answer. C. Asset protection from Medicaid spend-down requirements. Explanation. The Connecticut Partnership for Long-Term Care program allows policyholders of partnership-qualified policies to protect an equivalent amount of assets from Medicaid spend-down requirements. This means that if the policyholder exhausts their insurance benefits, they can apply for Medicaid without needing to spend down all their assets. This asset protection feature makes partnership policies highly valuable for individuals concerned about long-term care costs and Medicaid eligibility. Options A and B are not benefits specific to partnership policies, and option D is incorrect because premiums for partnership and non-partnership policies can vary based on other factors. Question 5. Which of the following is not considered an unfair trade practice under Connecticut's marketing guidelines for long-term care insurance? A. Misrepresenting the benefits of a policy to a potential buyer. B. Replacing an existing policy with a new one without explaining the differences. C. Providing clear and accurate comparisons between policies. D. Twisting a policyholder's current coverage to persuade them to switch policies. Answer: C. Providing clear and accurate comparisons between policies. Explanation: under Connecticut's unfair trade practices regulations, misrepresenting policy features, replacing policies without proper disclosure, and persuading a policyholder to switch policies by providing misleading information are all prohibited actions. These are unethical practices intended to manipulate or mislead consumers into purchasing new policies that may not be in their best interest. Option C is the correct answer because providing clear, accurate, and transparent information is a best practice and is required for ethical sales of long-term care insurance policies. Question 6. Scenario-based. MS. Lisa Adams is reviewing a long-term care insurance policy with her agent. She wants to make sure that her policy will cover her in case she requires nursing home care in the future. However, she is uncertain whether her policy's benefit trigger is based on the number of activities of daily living adults she can perform or on cognitive impairment. What should MS. Adams look for in her policy to understand how benefits will be triggered? A clause specifying that at least 3 DLS must be impaired. B. A provision stating that any diagnosis of a chronic condition qualifies for benefits. C. A section outlining either the inability to perform to a DLS or cognitive impairment requiring substantial supervision. D. A requirement that only home care needs are covered under the policy. Answer: C. A section outlining either the inability to perform to a DLS or cognitive impairment requiring substantial supervision. Explanation: the benefit triggers for most long-term care insurance policies, including those in Connecticut, are based on the inability to perform a certain number of activities of daily living adults, typically 2 or more, or the presence of cognitive impairment that necessitates supervision. MS. Adams should review her policy for language that specifies these triggers. Option A is incorrect because most policies require impairment in 2 adults, not 3. Option B is too broad as a diagnosis of a chronic condition may not trigger benefits. Option D is incorrect as long-term care policies often cover a variety of services, not just home care. Question 7. What is one of the main differences between a traditional long-term care policy and a hybrid life long-term care insurance policy? A. Hybrid policies do not require medical underwriting. B. Traditional policies offer both death benefits and long-term care benefits. C. Hybrid policies allow for a death benefit if long-term care is not used. D. Traditional policies always have higher premiums than hybrid policies. Answer: C. Hybrid policies allow for a death benefit if long-term care is not used. Explanation: a hybrid life long-term care insurance policy combines life insurance with long-term care coverage. If the policyholder does not use the long-term care benefits, the policy pays out a death benefit to the beneficiaries. This is in contrast to traditional long-term care policies, which only provide coverage for care and do not include a death benefit. Option A is incorrect, as hybrid policies typically require medical underwriting. Option B is incorrect because traditional policies do not offer death benefits, and option D is misleading since premiums for hybrid and traditional policies vary based on the specific features and individual underwriting. Question 8. Which of the following factors does not influence the premium rates for long-term care insurance policies in Connecticut? A. Age of the insured at the time of policy purchase. B. Policy features such as benefit limits and inflation protection. C. The insured's geographic location within Connecticut. D. Health status of the insured during the underwriting process. Answer: C. The insured's geographic location within Connecticut. Explanation: the geographic location of the insured within Connecticut does not typically affect the premium rates for long-term care insurance policies. Premiums are primarily influenced by the insured's age at the time of purchase, their health status, which affects underwriting, and the specific features of the policy, such as benefit limits, inflation protection, and elimination periods. Options A, B, and D are correct as these factors directly impact premium costs. Connecticut's regulations ensure that premiums are fair and based on relevant underwriting criteria. Question 9. Under Connecticut regulations, when can an insurance company increase premiums on an enforced long-term care policy? A. At any time as long as the insured is notified in writing. B. Only after receiving approval from the Connecticut Department of Insurance and proving the need based on claims experience. C. Only during the first 5 years of the policy. D. When the insured's health deteriorates significantly. Answer: B. Only after receiving approval from the Connecticut Department of Insurance and proving the need based on claims experience explanation. In Connecticut, long-term care insurers must obtain approval from the Connecticut Department of Insurance (DOI) before increasing premiums on enforced policies. The insurer must demonstrate that the premium increase is justified, typically due to higher than expected claims experience. This is a consumer protection measure designed to prevent arbitrary or excessive premium hikes. Options A, C, and D are incorrect because premium increases are not allowed at any time, only in the first few years or due to health changes. Connecticut's regulations ensure transparency and fairness in premium adjustments. Question 10. Which of the following is not a requirement for a long-term care insurance policy to be considered a tax-qualified plan under the Health Insurance Portability and Accountability Act (HIPAA 8)? The policy must only pay benefits when the insured cannot perform at least 2 activities of daily living adults. B. The policy must provide a waiver of premium after a specified waiting period. C. The policyholder must be certified by a licensed healthcare practitioner as chronically ill. D. The policy must be guaranteed renewable. Answer: B. The policy must provide a waiver of premium after a specified waiting period. Explanation: for a long-term care insurance policy to be tax qualified under HIPAA, it must meet specific criteria such as requiring the insured to be unable to perform at least 2 activities of daily living adults or having a cognitive impairment. The insured must also be certified by a licensed healthcare practitioner as chronically ill. Additionally, tax-qualified policies must be guaranteed renewable. The waiver of premium provision is optional and not a requirement for tax-qualified status, making option B the correct answer. Options A, C, and D are key requirements under HIPAA. Question 11. Which type of long-term care service is typically the least expensive and often used as an alternative to full-time nursing home care? A. Assisted living facility care. B. Home health care. C. Adult daycare. D. Skilled nursing facility care. Answer: C. Adult daycare. Explanation: adult daycare is typically the least expensive option compared to other long-term care services such as nursing home care or assisted living. Adult daycare centers provide supervised care during the day, offering social activities, meals, and sometimes medical services. This option allows family members to continue working while providing the care their loved ones need. Home health care and assisted living facility care can be more expensive, while skilled nursing facility care is usually the most costly because it provides comprehensive, round-the-clock medical care. Question 12. Scenario-based. Mr. Kevin Davis has a long-term care insurance policy with a daily benefit of $200 and a 90-day elimination period. After suffering a stroke, Mr. Davis requires nursing home care costing $180 per day. How much will Mr. Davis have to pay out of pocket during the elimination period before his policy starts covering the costs? A. $5,400. B. $16,200. C. $18,000. D. $36,000. Answer: B. $16,200. Explanation: the elimination period in a long-term care insurance policy is the waiting period before the policy starts paying benefits. Mr. Davis's elimination period is 90 days, during which he must pay for his care out of pocket. The cost of his care is $180 per day. The total amount he will pay during the elimination period is 90 days x $180 equals $16,200. Therefore, Mr. Davis will pay $16,200 out of pocket before his policy begins covering the costs. Question 13. What is one of the primary reasons for the Connecticut Department of Insurance to deny a claim for long-term care benefits? A. The insured was under the age of 65 at the time of the claim. B. The insured failed to meet the benefit trigger based on a DLS or cognitive impairment. C. The insured's policy included a non-forfeiture option. D. The insured had waived their premium for too long. Answer B. The insured failed to meet the benefit trigger based on a DLS or cognitive impairment. Explanation: a common reason for the denial of long-term care benefit claims is that the insured does not meet the benefit trigger. In most cases, these triggers are the inability to perform a specified number of activities of daily living adults, usually two or more, or significant cognitive impairment requiring supervision. The age of the insured is not typically a reason for claim denial, nor is the existence of a non-forfeiture option. C. Waiving the premium. D. Does not affect eligibility for benefits. Question 14. Which of the following provisions is often included in long-term care insurance policies to help protect against inflation? A. Waiver of premium. B. Shared care rider. C. Compound inflation protection. D. Non-forfeiture benefit. Answer C. Compound inflation protection. Explanation: compound inflation protection is a feature that helps long-term care insurance benefits keep pace with inflation. Each year, the policy's benefit amount increases by a certain percentage, ensuring that the benefits retain their value over time even as the cost of care rises. This feature is especially important in long-term care policies where the cost of services can significantly increase over time. Options A, B, and D serve other functions, waiving premiums during claim periods, allowing shared care between couples, and offering non-forfeiture benefits if the policy lapses. Question 15. In Connecticut, which of the following is a requirement for continuing education for long-term care insurance producers? A. Completing a 5-hour ethics course every 2 years. B. Completing 8 hours of training on long-term care insurance prior to selling policies and 4 hours every 2 years thereafter. C. Taking a 10-hour annual refresher course on long-term care marketing practices. D. Participating in quarterly seminars hosted by the Connecticut Department of Insurance. Answer B. Completing 8 hours of training on long-term care insurance prior to selling policies and 4 hours every 2 years thereafter. Explanation: in Connecticut, long-term care insurance producers are required to complete 8 hours of initial training on long-term care insurance before they are allowed to sell policies. After that, they must complete an additional 4 hours of training every 2 years to stay current with the laws and best practices. This continuing education helps ensure that producers are knowledgeable about policy options, regulatory changes, and ethical sales practices. Options A, C, and D are not Connecticut requirements. Question 16. Which of the following best describes the free look period for long-term care insurance policies in Connecticut? A 30-day period in which the insurer cannot raise premiums after policy issuance. B. A 30-day period during which the policyholder may review and return the policy for a full refund. C. A 10-day period in which the insurer must investigate and deny or approve any filed claims. D. A 15-day period in which the insured may request additional policy benefits at no extra cost. Answer B. A 30-day period during which the policyholder may review and return the policy for a full refund. Explanation: the free look period is a consumer protection measure allowing the policyholder to review their long-term care insurance policy for 30 days after receiving it. If the policyholder decides the policy does not meet their needs, they can return it to the insurer for a full refund. This provision ensures that consumers have the opportunity to carefully evaluate the policy terms without feeling pressured into a decision. Options A, C, and D do not accurately describe the purpose of the free look period. Question 17. Which of the following services is typically covered under a long-term care insurance policy that includes home health care benefits? A. Skilled nursing care provided in a nursing home. B. Physical therapy services provided at the insured's home. C. Hospitalization for acute illness. D. Assisted living facility care. Answer B. Physical therapy services provided at the insured's home. Explanation: a long-term care insurance policy that includes home health care benefits typically covers services such as physical therapy, occupational therapy, and skilled nursing care provided in the insured's home. This allows the policyholder to receive care in a more comfortable and familiar environment, reducing the need for institutional care. Options A, C, and D involve services that take place outside of the home, such as care in a nursing home or hospital, and are not included in the home health care coverage. Question 18. What is the primary purpose of the waiver of premium provision in long-term care insurance policies? A. To refund premiums paid in advance after a policyholder dies. B. To allow policyholders to stop paying premiums when they start receiving benefits. C. To reduce the total premium amount if the policyholder remains healthy. D. To eliminate premium increases during the first 5 years of the policy. Answer: B. To allow policyholders to stop paying premiums when they start receiving benefits. Explanation: the waiver of premium provision in long-term care insurance policies allows the policyholder to stop paying premiums once they start receiving benefits. This provision provides financial relief to policyholders during a time when they are likely to have additional expenses related to their care. Options A, C, and D are incorrect because the waiver of premium provision is unrelated to refunds, health status, or premium increases. Question 19. Which of the following is a key difference between a guaranteed renewable policy and a non-cancelable policy? A. Non-cancelable policies allow the insurer to increase premiums based on health status. B. Guaranteed renewable policies can be cancelled by the insurer. C. Non-cancelable policies do not allow the insurer to increase premiums. D. Guaranteed renewable policies lock in the premium for the life of the policy. Answer: C. Non-cancelable policies do not allow the insurer to increase premiums. Explanation: the key difference between guaranteed renewable and non-cancelable policies lies in the insurer's ability to increase premiums. With a non-cancelable policy, the insurer cannot change the premium or cancel the policy as long as the policyholder continues to pay premiums on time. In contrast, a guaranteed renewable policy guarantees that the policy will not be cancelled as long as premiums are paid, but the insurer reserves the right to increase premiums for an entire class of insured individuals, not based on individual health status. Option D incorrectly implies that guaranteed renewable policies lock in premiums. Question 20. Which of the following is a common exclusion found in long-term care insurance policies? A. Coverage for care in assisted living facilities. B. Coverage for pre-existing conditions for a limited time. C. Coverage for Alzheimer's disease. D. Coverage for injuries resulting from self-inflicted harm. Answer: D. Coverage for injuries resulting from self-inflicted harm. Explanation: most long-term care insurance policies have exclusions that limit coverage for specific situations. One common exclusion is for injuries resulting from self-inflicted harm. This includes situations such as attempted suicide. Pre-existing conditions may also be excluded for a limited time after the policy is purchased, but conditions such as Alzheimer's disease and care in assisted living facilities are typically covered if the policy includes such benefits. Therefore, option D is the correct answer. Question 21. In Connecticut, what is the minimum number of days of nursing home care that a long-term care insurance policy must provide? A. 30 days. B. 60 days. C. 180 days. D. 365 days. Answer: D. 365 days. Explanation: in Connecticut, long-term care insurance policies are required to provide at least 365 days of nursing home care. This regulation ensures that policyholders have access to extended care if necessary. The other options A, B, and C are incorrect because the state's minimum requirement is for 1 full year, 365 days of coverage for nursing home care. Question 22. Which of the following best defines the term activities of daily living adults in the context of long-term care insurance? A. Daily activities that a person chooses to engage in for leisure. B. Basic personal care activities that are necessary for independent living. C. Advanced medical procedures required for chronic illness management. D. Household tasks like cooking, cleaning, and grocery shopping. Answer: B. Basic personal care activities that are necessary for independent living. Explanation: activities of daily living adults refer to the basic personal care activities that individuals must perform to maintain independent living. These typically include bathing, dressing, eating, transferring, toileting, and maintaining continence. Long-term care insurance policies often use the inability to perform a certain number of DLS as a trigger for benefits. Options A, C, and D are incorrect because they describe activities unrelated to the ADL definition used in insurance policies. Question 23. What is the primary benefit of including an inflation protection rider in a long-term care insurance policy? A. It guarantees that premiums will never increase. B. It ensures that benefit amounts increase over time to keep pace with rising care costs. C. It provides additional coverage for hospital stays and acute care. D. It allows the policyholder to cancel the policy without penalty. Answer: B. It ensures that benefit amounts increase over time to keep pace with rising care costs. Explanation: the primary purpose of an inflation protection rider is to ensure that the benefits provided by a long-term care insurance policy increase over time, keeping pace with the rising costs of care. This helps protect the policyholder from inflation eroding the value of their benefits. Inflation protection is a valuable feature, especially in policies that may not be used for many years after purchase. Option A refers to premium stability, option C to hospital care, and option D to policy cancellation, none of which are related to inflation protection. Question 24. Under Connecticut regulations, long-term care insurance policies are required to include which of the following provisions? A 10-day free look period. B, a non-forfeiture benefit as an option. C, a guaranteed increase in benefits every 5 years. D, coverage for all types of nursing home care, regardless of the level of care required. Answer: B, a non-forfeiture benefit as an option. Explanation: Connecticut regulations mandate that long-term care insurance policies offer a non-forfeiture benefit as an option. This benefit allows the policyholder to retain some of the benefits even if the policy lapses due to non-payment of premiums. This is designed to provide policyholders with value for the premiums they've paid. The free look period in Connecticut is typically 30 days, not 10, and the other options, C and D, are not regulatory requirements. Question 25. In a long-term care insurance policy, which of the following best describes the elimination period? A, the maximum number of days the policy will pay benefits. B, the period during which the insurer investigates the claim. C, the waiting period before benefits begin after a qualifying event. D, the period during which premiums are waived after a claim is filed. Answer: C, the waiting period before benefits begin after a qualifying event. Explanation: the elimination period in a long-term care insurance policy refers to the waiting period between the time a qualifying event occurs, such as the inability to perform activities of daily living, and when the policy begins to pay benefits. This period acts like a deductible where the insured is responsible for covering care costs during the elimination period. Options A, B, and D describe different aspects of long-term care policies but do not define the elimination period. Question 26. Which of the following riders in a long-term care insurance policy allows a couple to share benefits between their two policies? A, return of premium rider. B, shared care rider. C, inflation protection rider. D, waiver of premium rider. Answer: B, shared care rider. Explanation: a shared care rider allows a couple to combine the benefits of their long-term care insurance policies, giving them flexibility in how they use the total benefit pool. If one partner exhausts their own benefits, they can access the other partner's benefits. This feature is particularly useful for couples seeking to maximize their coverage. The other riders A, C, and D serve different purposes, such as refunding premiums or adjusting for inflation, but do not enable benefit sharing between policies. Question 27. Which of the following is typically excluded from coverage under a long-term care insurance policy? A, home health care services. B, care provided by family members. C, skilled nursing care in a licensed facility. D, hospice care. Answer: B, care provided by family members. Explanation: most long-term care insurance policies exclude care provided by family members, even if those family members are capable of providing the necessary care. This is to prevent abuse and ensure that professional, certified care providers are used. Services like home health care A, skilled nursing care C, and hospice care D are typically covered as part of comprehensive long-term care policies. Question 28. Which of the following is a characteristic of a partnership long-term care insurance policy in Connecticut? A, it allows policyholders to transfer their benefits to other states without restrictions. B, it includes a Medicaid asset protection feature. C, it provides unlimited lifetime benefits. D, it allows for premium payments to be suspended during periods of unemployment. Answer: B, it includes a Medicaid asset protection feature. Explanation: a partnership long-term care insurance policy in Connecticut and other states offers the Medicaid asset protection feature, which allows policyholders to protect a portion of their assets if they exhaust their policy benefits and then need to qualify for Medicaid. This feature encourages individuals to purchase private long-term care insurance while providing some financial security. The other options are not typical characteristics of partnership policies. Question 29. Which of the following is required in a long-term care insurance policy under federal tax qualified status? A. The policy must include an inflation protection rider. B. The policyholder must be able to deduct premiums on their taxes. C. The policy must pay benefits when the insured is unable to perform at least 2A DLS for at least 90 days. D. The policy must cover all costs associated with assisted living facilities. Answer: C. The policy must pay benefits when the insured is unable to perform at least 2A DLS for at least 90 days. Explanation: under federal tax qualified long-term care insurance regulations, the policy must pay benefits when the insured is unable to perform at least 2 activities of daily living adults for a period of at least 90 days, or when the insured has a cognitive impairment such as dementia. This is one of the key requirements for tax qualified policies. The other options either describe optional features and D or are related to tax deductions, which depend on specific tax laws. B. Question 30. Which of the following scenarios would likely trigger the payment of benefits under a long-term care insurance policy? A. The insured moves into an independent living retirement community. B. The insured is diagnosed with a terminal illness but is still able to perform all adults. C. The insured is no longer able to perform 2A DLS and requires assistance with bathing and dressing. D. The insured experiences a temporary hospitalization for pneumonia but recovers fully. Answer: C. The insured is no longer able to perform 2A DLS and requires assistance with bathing and dressing. Explanation: a common trigger for long-term care insurance benefits is when the insured is no longer able to perform at least 2 activities of daily living adults, such as bathing and dressing, and requires assistance. This is a typical condition for policyholders to receive benefits. Scenarios A, B, and D do not meet the standard criteria for triggering benefits under a long-term care insurance policy.